Question 32, Ennea. This question is going to cover the impact of reconstruction on the balance sheet and income statement, and also gearing, EPS, earnings, and also securitization, right? So here in this question, you have been given three proposals. Under three proposal, what is the impact on the balance sheet and also on the income statement? So first we'll go through the requirements. Requirement A is 20 marks. Okay, estimate and discuss. So you need to estimate as well as discuss. That means you have to calculate also, you have to discuss also after calculation what it means. The impact of each of the three proposals on the focus statement of financial position, the earnings, EPS, gearing. So that means we have to show the impact on many things. First is financial position, earnings, EPS, gearing. Worth 20 marks. Part B, an alternative suggestion to proposal 3 was made where the non-current assets would be leased, okay, could be leased. So in proposal 3, you are selling the non-current asset, but here they are saying rather than doing that, it is better to lease the non-current assets to the other companies instead of being sold. And the lease receipts would then be converted into an asset through securitization. The proceeds from the sale of the securitized lease receipts asset would be used to reduce the outstanding loan borrowings. Explain what the securitization process would involve and what would be the key barriers to any company undertaking the process. Even in part B, there are two things which you need to focus on. What is securitization process? Okay, that is number one. Number two is key barriers. Key barriers for undertaking the securitization process. So that is number two, worth 5 marks. So first we'll go through this. What are the three proposals we'll see? Three proposals are put forward for further consideration after meeting of the executive directors of the company to discuss further future investment and financing strategy of business. Ennea is a listed company operating in the haulage and the shipping industry. Proposal 1. To increase the company's level of debt by borrowing a further 20 million and use the fund raised to buy back the share capital. You should know what happens when you buy back the share capital. Like in your mind, you have to visualize what is happening to your share capital. What will happen in the proposal 1? What will change? Your long-term liability will increase, your debt will increase. Okay, you have to visualize this before even you actually start writing. When you read it, you have to understand what is the impact, where are the changes happening. Your cash will reduce. Why? Because we are assuming that we are paying the debt, right, by cash. We have to pay interest on the debt. So all this we are paying by cash. If we are taking a long-term loan means we have to pay more interest now. So on that we are paying, and that will be reduced from our cash. So our cash will reduce. Long-term liabilities increasing. Share capital will reduce because the fund are raised to buy back the share capital. So our share capital will go down. Return earnings will get affected, right? Because of your interest in the long-term loan, profit, and all those things, your return earnings will get impacted. So these are the 4 places where changes will happen: share capital, return earnings, cash, and your long-term liability. So here, increase debt 20 million and buyback share. That is proposal 1. Proposal 2, increase the company's level of debt by borrowing a further 20 million. Okay, here also same old if. Okay, increase debt 20 million and use this funds, this time use this funds to invest in additional non-current assets. So that means you are taking a debt and that amount you are using to invest in additional non-current assets. So your additional non-current asset also will go up now. Before proposal 1, your share capital was reducing. Now your debt also will increase, non-current asset also will increase in your balance sheet. Now proposal 3, to sell the excess non-current haulage asset with a net book value. That means your non-current asset you are selling, and that net book value of the non-current asset is 25 million. And out of that, you are selling how much? You are selling it for 27 million. That means there's a profit of 2 million, right? 25 millions worth of assets you are selling for 27 million. So there's a 2 million profit. This 2 million profit will go where? This is a profit on disposal. This will go in your retained earnings. It will impact in your retained earnings, right? And focus on offering. So they are going to sell the non-current asset, and what they are going to do, focus on offering more services to the shipping strategic business unit. This business unit will require no additional investment in non-current asset. That service which you are going to provide, you don't need any investment in non-current asset there. All the funds raised from the sale of the non-current asset, right? So that all the funds raised from the sale means this is 27 million. This is you are receiving. So this is used. From this, you are going to reduce your company's debt. That means you are going to pay off your debt. So your debt will reduce this time. Asset will increase, debt will reduce. Sorry, asset will reduce, debt also will reduce. But your cash amount will increase. And also retain earnings because of the profit. Now, financial information is given. So this is your financial position. This you have to keep changing for all the three proposals. Next, we have been given some information because we have to get the effect on the earnings and the earnings per share. So that for earnings per share, we need to have earnings, right? To have that earnings, we need a profit statement. So to draw that profit statement, this information is there. Ennea's forecast profit after tax for the coming years expected to be 26 million, and its current share price is 3.2 per share. So after tax profit is 26 million. Share price, this is the current share price, 3.2 per share. Non-current liabilities consist solely of a 6% medium-term loan redeemable within 7 years. This is given for you to calculate your interest, additional interest. Okay, if you are taking loan, the terms of the loan contract stipulate that an increase in borrowing will result an increase in coupon payable of 25 basis point on the total amount borrowed. You have to take care of this also. Because that increasing borrowing is increasing, what happens? Coupon will also increase. 25 basis point on the amount borrowed. But if there's a, and this happens when there's an increase in borrowing, while a reduction in borrowing will lower the coupon payable by 15 basis point. That is reduction in borrowing. Now, tax rate, effective tax rate is 20%. Company's estimated after tax rate of return on investment is expected to be 15% on any new investment. So 15% on any new investment is the after tax of return. You don't have to adjust it for tax. It is already adjusted. After tax means adjusted. If it was before tax or pre-tax, then you have to adjust for tax, remember. But this is, here it is after tax rate of return. Okay, and 15%. Because it's just not borrowings we are also doing some investment in non-current asset. So for that investment, the return is 15%. Now, it is expected that any reduction in investment would suffer the same rate of return. That means whether your investment, right, you are making a new investment or your investment is reducing, it doesn't matter. Rate is 15% only. Not like borrowings. We saw in borrowings that when you increase the borrowing, it is 25 basis point. When you reduce the borrowing, it is 15 basis point. But with investment, whether you make new investment or whether you don't make investment, it reduces. Rate is 15% only because they have given it like that. So now we're going to show this the balance sheet. Before we do the balance sheet, where is your starting point? How do you know where to start from? Are you going to start from proposal 1, proposal 2, proposal 3? If you are saying proposal 1, then you are wrong. You're not starting from proposal 1. How will you start from proposal 1? First, you have to draw this. This has to be there. Just copy paste it. Write all the figures from here again. This is your current situation. First, always you have to start with your current position. That has to be near you. You have to do this in a column, right? This, this is proposal 1, this is proposal 2, this is proposal 3. And this is the current situation. This is how you are going to show the impact. You're not going to write every time under proposal 1 non-current assets, current assets, total assets. Under proposal 2 non-current assets, current assets, total assets. Every time you're not writing it. Only once you're writing all this description, only thing will change is the numbers. That's it. The numbers will keep changing in each column. What happens because of this? It's easier to compare. Everything is in one line, one table. It is faster, it is time saving, and it looks more neat, professional. So the way you present your answer, again very important, especially when such question comes, show the impact of that after changes, before changes. This type of question comes, always you have to make a table in a table format. Now I will take you through the answer, how the answer is presented. Before I take you to the marking scheme, we'll go through the answer. So part A, if you see focused financial position, this is how your financial position is given, right? I will zoom it. This is your financial position. If you see current, proposal 1, proposal 2, proposal 3. This current is taken from the question only from exactly copy paste. So you have to write it again, starting with non-current assets, current assets, total assets, all those things copy paste again. Once you're done, now we can show the impact on the proposal 1. So what was proposal 1? Increase in the borrowing by 20,000. Okay, 20 million, because we are dealing in thousands. Remember this also. Very important is this, because you are dealing in millions. So you're dropping down the 3 zeros, the last 3 zeros when you're working out, right? So you're increasing the borrowing by 20 million. So your non-current asset, will it change? It will not change. It has nothing to do with non-current asset in proposal 1. That's why it is 282 here, 282 here also. Same. Current asset, yes, current assets will change because in your current assets we have cash, right? But to that will come later. Don't write it now. Leave it leave blank. You have to work out. Next, go to your current liabilities. Current liabilities will change? No. 37,000 only. Non-current liabilities, yes, it will change by 20 million. That's that. Before it was 140. Now it is 160,000 because you are adding 20. Your share capital will reduce, as I told you, because you are buying back the share. So your share capital will reduce. We'll do the working. Keep it a blank now. Retained earnings, it will change. Retained earnings will change in all the 3 proposals. Right? So first we'll see. Now we are going to go here to our, we have to get the earnings. Why we need earnings before getting before completing the balance sheet? Because to complete the balance sheet there are some items that you have to take from your income statement, from your earnings, right? Profit and loss account, you have to take some like retained earnings, you cannot take that balance. Share capital, you need to do workings for that. So keep it blank. Okay, I'm going to use a different color pen for each proposal. So proposal 1, I'm going to use red color. Okay, so for this, and where is the next one? Next is share capital and the retained earnings. So wherever I have put the dot, we are focusing on that only. We have to find the current assets, share capital, retained earnings, right? So now again we have to do like this. Current, we have been told that profit after tax is 26,000. Will your profit after tax change? No, it will remain the same only under all the proposals. That's why 26,000 only. Now scenario 1, what are you doing? You are taking on 20 million additional borrowing. Because of that, what you have to do? You have to pay interest also. Interest payable on additional borrowing. So 20 million into 6%, because the rate has been given to you 6%. 1 minus 0.2 is your tax. Your tax is 20%. Right? That's why it is 1 minus 20%. 80% you are taking, which is 960 here. It has to be deducted. It's an interest payable. It has to be deducted from your profit after tax, which is 26,000 minus 9. Under current situation, there will be nothing. It will be 26,000 only. Under proposal 1, we are here now. Okay, we are in proposal 1 now. So don't look in your proposal 2 and 3. Just focus in proposal 1. Because if you look there, you will get very confused. We are dealing one by one. Proposal by proposal will come. So now just proposal 1, 960. Next is, we saw that the coupon increased. This is an additional borrowing. So coupon will increase to 25 basis point. That also you have to take into account. Right? So additional interest payable. First it was interest payable on additional borrowing. Because of that borrowing 20 million. Now interest is additional interest payable. So you have to take this 160. Why 160? It is your new, not the increased amount. Here you are taking 20 million, by the way. The difference comes here. The difference, that 20 million you are paying 6%, but in the next one, on this 160, this one, on this 160,000 itself, you are paying, what is the interest? 0.25. Coupon rate is 25 basis point. So 0.25 after tax, that's why 1 minus 0.2. Here also after tax you have to take. Right? Whenever it's additional interest payable, then you have to use the new debt. That is 160. Not 20 million into 0.25%. So make sure that you use the correct amount. It is 160, the new debt. So you are getting 320 deducted. It will be deducted. That's it for proposal 1. So 26,000 minus 960 minus 320 will give you 24,720. That is your, here they have written total assets, but it is your earnings only. It is your earnings only. Right? Next. So 24,720 is your what? Earnings. So this retained earnings, what do you have to do? How are you getting retained earnings? Okay. To get retained earnings, first you have to start with the, okay. See, current assets you can do easily. Why? Current asset, just take the 66,000 from here. Currently, okay, current amount 66,000. From 66,000 you have to deduct 960 and 320, right? So here we'll deduct, I don't know why I'm not able to write, 66,000 minus, that is your current asset. Out of that you are deducting, what is the interest you are paying? 960 and 320. So the balance is how much? 64,720. Check it by yourself. Right? You are getting 64,720. Exactly, that is your closing cash balance. 64,720. So this is done. This is solved. Now we have to work on the share capital, because without working on the share capital, you cannot get the return earnings. First, you have to start with the share capital only. So share capital, okay. What is the number of share? Somewhere working has been done here when they were calculating gearing. So we'll take that only. Okay. So how you are increasing the debt by how much? 20 million. Exactly by that same amount you are buying back the share. With that amount itself you are buying back the share. So we are doing here 20 million divided by, what is the share price? The share price was given as 3.2. Here you can see, to find number of shares they have done this. from here itself we can show you the working. When they were calculating gearing, the working is here 20 million, because 20 million we are buying back the shares worth of 20 million. Divide by 3.2 because share price is 3.2. Current share price is 3.2. So the total number of share is 6.25. 6.25 million shares are bought back. But this needs to be multiplied by 0.4. This 6.25 here. This needs to be multiplied by 0.4 back. Okay. Because if you go to your balance sheet, just check here, 40 cents per share. To find the value, the share capital, so 6.25 is number of share. But if you want to find the value of share, it will be 6.25 into 0.4, which will be how much? 2.5. Keep this aside for now. Okay. So this is 6.25. Right. So you have to find your number of shares currently. How much? What is your current number of shares? Okay. Look at your share. It is 48 million and 40 cents per share. So number of share is 48 million divided by 0.4. So 48 here divided by 0.4, it is 120,000. From this 120,000, how much you have to reduce? 120,000 is number of shares, right? So the number of share is here 6.25. So 120, okay, minus 6.25. You will get 113.75. Exactly this is the amount here. Say this. It is 113,750 only. This is how you work when you have to calculate the number of shares, how much it has reduced. Right? So it has reduced to up to 113,750. That is the number of shares. Right? 113. But this is in number of shares. This again needs to be taken into value. How are you going to take this into value? How are you going to take this 113,750 into value? Multiply by 0.4. Right? Multiply this by 0.4. Everything needs to be multiplied by 0.4 at the end because this is number of share. So per share is 0.4. So it is 45,500. If you see here, just check here. It is 45,500 number of share. Sorry, the share capital. There is another way of working out this 45,500. Here you can see it is 48,000. Okay. We have calculated this, right? This previously we have calculated. I told you we'll keep it here. This. So what we are doing is 48 minus 2.5. You are getting 45.5. Exactly the same amount only you will get. So there is two way of doing. You could either do this way, the first one or the second one, where you minus the number of shares and then multiply by 0.4, or you can take it from 48 minus 2.5. This, it will be little confusing for you. You might get little stuck, don't know what to multiply and which raise to take. That's why practice this question many times, or practice there are I think there are 2-3 questions like this where you have to find where the share capital is reduced. Try to attempt these questions more and practice on this area. Try to work out how much the share is reduced and all, for you to understand this better. Next, so even the share capital is done. Now we are done with retained earnings. We are left with what? Retained earnings. How are we going to calculate retained earnings? From retained earnings, retained earnings currently is 123,000. From 123,000, you have to deduct 17,500. Confused? Are you confused? Or no? Well, why you're minusing 17,500? This is retained earnings. Because what is your total value that you have to buy back the share? It is, I don't know why my pen is not working. Okay, it is 20 million. Out of this 20 million, 2.5, it is in your share capital. If you see, share capital is reducing, right? Your share capital is reducing by this amount. The rest, 17.5, the balance, right? Out of this 20, 2.5, your share capital is reducing, and the balance 17.5, your return earnings will reduce. It's always like this. Whenever your share capital reduces, remember, first you work out how much share capital is reducing, and the balance will be deducted from return earnings. Usually it is deducted from share premium, right? But for simplicity, in this case, we are deducting it from return earnings because we haven't been given any share premium. Okay, so whenever return earning is given to you, no share premium is given, deduct it from return earnings only. So that's why first you have to deduct the 17.5 from return earnings, and then again you have to minus this two. This two needs to be deducted from retained earnings, the interest 960 and 320, and then you will get this 104,104,220. That's how you get the retained earnings. You deduct how much the share reduced, the balance of it, and deduct the interest, additional interest, and interest payable on additional borrowing. So that's how you work on your retained earnings. It is little complicated. It's not complicated, I would say, but at first glance you might not understand. Keep practicing. Maybe the same questions you might do 2-3 times also. It's okay, unless you get your figures right. Now let's go to proposal 2. Proposal 2, your non-current asset will increase by 20. That's why it is 302 here. Right? Your current assets also will change. So we'll put a dot here. Your current liabilities will not change. It will remain same. Your non-current liabilities, it will be 160 because again, see, one mistake candidates I have seen personally, they are doing is, what they are doing is when they go to proposal 2, they started taking figures from proposal 1. So let's say here non-current liabilities, it is 160. Here is 160, right? In proposal 1, when they take here, they told it's 20 million. So what they do is they take 180 million. Sorry, 180,000. 180,000. No, please don't do this mistake. Let me cut this out. Don't do this mistake. Okay, check. This is proposal 1. You have to compare from the current only. Every time when you go to proposal 1 with the current only, you have to compare. It's not proposal 1 to 2 or 2 to 3. So from 140, you have to increase 20. So again, it will be 160 only, your non-current liabilities. This time, remember your share capital. Will it change? No, nothing to do with share capital. Your non-current liabilities and debt only will increase. So your share capital 48,000, 48,000 only. Return earnings, yes, it will change. Your return earnings will change. So your return earnings, non-current assets, long-term liabilities. Non-current assets and long-term liabilities, we know 20,000 you increase it. Return earnings and your current assets, that is your cash, you need to do working. Right? The same for current asset, it is 66,000. Right? See, interest for proposal 1 and 2 will be same only because still the debt you are increasing, the borrowing which you are increasing is by 20 million only, even under in proposal 2. So there's no difference. It will be 960, it will be 320 only. The only difference is this one, this 3000, additional 3000. What is this 3000? You are making an investment in non-current asset in proposal 2. So because I'm making an investment, what is the rate of investment? Post-tax rate of return on investment 15%. That's why it is 20 million into 15%. And it's a return, it's a positive figure. So 3000 you have to add. So that 3000 is coming in proposal 2. That's why if you see your cash also, it is higher than proposal 1. So you minus 66,000 minus 960 minus 320 and add 3000, you will be getting 67720. So this is done. Now retained earnings. Retained earnings this time is easy to calculate because there is no share reduction or something. You just have to deduct what from 123,000, right? Current retained earnings 123. What do you have to do? You have to deduct 960 minus 320 and add 3000. You will be getting 104,720. Right? Next, proposal 3. So proposal 3, if you see non-current asset, you are selling of non-current asset. How much? 25. Worth of 25, right? So it will be 282 here. 282, it is your current minus 25 because your net book value 25. So it is 257. This time your non-current asset is going down. Going down. Next, your current asset. We'll come on that later. Current liabilities will remain same, and this time your non-current liabilities is reducing. Non-current liabilities will reduce, not increase, from 140. How much? It will reduce by 140 minus 27 because you're selling. How much you're receiving by selling? You're selling this non-current asset for 27. It is worth 25. You're selling for 27. So you're getting 27 in cash. So that 27 in cash you are using to pay off your debt. That's why 27 you are deducting from 140. So your non-current liabilities also reduces to 113. Next, come to your share capital. It will be 48,000. No impact on share capital. Return earnings, yes. In all the proposal, return earnings will change. So now we'll see the cash. Cash is 66,000 current. With that, what you have to do is add 1296, add 136 minus 3750. And also, you're not adding this 2000 by the way. Don't add this 2000 in your current asset. Why? It's a profit on sale of non-current asset. Remember 25 worth of good we are selling for 27. So 2000 profit. That's why this profit. But you're not deducting it because it's not cash. Current asset we are only care about cash. So we are only getting interest, right? We are saving interest and we are losing interest. So only for this one, this one and this one, the 3 transactions cash is involved. Last one we are not doing anything. So that's why we are not taking it into account and we are getting this. Next, retained earnings. Okay. Now what happens is you are selling of non-current asset. That means your investment is reducing, right? So because your investment is reducing, your non-current liabilities is going down. First, we'll work with the non-current part. It's easier to work with the non-current part. So non-current liability is going down. By how much? 27 million. So interest saved. Interest will be saved this time. Whenever your borrowings goes down, interest, you are saving interest because you don't have to pay interest now. So interest on reduced borrowing is how much? 27 into 6% into 1 minus 0.2 because that is a tax. Tax is 20% and 6%. So it is 1296 you are saving. Now, because borrowing is reducing, what happens? They told when borrowing is reducing, coupon rate will reduce. So on this 113 now, what is your new borrowing? 113. From a balance sheet you can take into 0.15 because coupon 15 basis point and tax. So it is 136, right? This also needs to be added. Next, return is reducing. because 20 million we are selling non-current asset. So because of that, sorry, I'm sorry, this is for propose. See, this is what happens when you work in different columns like this. Don't make this mistake. This, when I was discussing 20 million into 15%, this is this 3000, which comes under proposal 2. We are here now. This is for proposal 3. Return lost on reduced investment. How much we are selling? 25, not 27. 25 we have been selling it. 25 million worth of asset is reducing. So by that reduction, you are taking 15% because doesn't matter reduction or increasing, it will be 15% only. So 25 into 15, it's in bracket because we are losing it, right? Next, there's a profit also. We have to take the profit also because this profit, by the way, this 2000, this needs to be taken into account for your return earnings. When you take your return earnings, this will be taken into account. There you have to add. So here you will see it is 122,682, right? Now you shall be getting all the figures. Even here you shall be able to complete all the figures by now. Now let's go to the gearing. So gearing, whenever you write a gearing, write the formula also, write this formula. It will help you. And also it's a good advice. I always advise whenever something is used where formula is needed, put that formula. It doesn't matter whether the formula is in your head or it's in a formula sheet or you remember or not, write the formula. Now, gearing, non-current liabilities, divide by non-current liabilities plus equity. Non-current liabilities we know, okay? But for our equity, we need to know the number of shares basically. This number of shares we need to find EPS, right? Okay, so non-current liabilities over non-current, okay, so non-current liabilities and equity we can take from the balance sheet itself. Currently, non-current liabilities is 140, right? Equity, when you take, you have to take your return earnings plus share capital. This you have to take. Okay, 171 total equity. So let me calculate you the gearing for the first one, current one. Okay, non-current liabilities is 140, 140,000 plus your 171. Okay, it will come in your denominator 140 plus 171. It is 45%. Just check here. 45%. Right? So likewise for the other 3 years also you will be able to calculate from the balance sheet. You have drawn the financial position, right? So from here itself, proposal 1, 2, 3, from balance sheet itself you can take non-current liabilities plus your total equity. And you should be able to get the gearing 45, 51.7, 48.1, 39.8. Now we have to find the number of shares. Why? Because we have calculated everything except one. What is it? EPS, earnings per share. Because we have been told to show the impact on this also. Earnings we know. Earnings are this are your 4 earnings. But your denominator, earnings per share, number of shares. We don't know our number of shares. We have to calculate the number of shares. Number of shares is 120 current, 48 million divided by 0.4, right? It will be same for 2 and 3. Only for proposal 1 it changed, right? 113.750. So when you calculate your EPS, let me show you the first EPS, the current year EPS. My earnings is 26,000. Divide by number of share was 120. What is it? 21.67. You'll be getting 0.216 something, right? When you take it in cents, it will be 21.67 cents. Likewise, you will be able to calculate everything except of proposal 1, where the denominator is not 120,000, it is 113,750. And note, other calculations of gearing would be acceptable. That's why it's very important for gearing you show the formula, because there are different formulas for gearing. Now, tutorial note. So we have done the calculation part. Now we have to explain. We are in the explanation part. These explanations are not required for the answer, but are presented here to aid answer. Okay, so this explanation, whatever they are given here, it is not required for your answer. It is only here for you to understand how the figures came, and for you to understand better. But this discussion you need, because you need to discuss also, right? So quickly I can go through the explanation. I have explained everything, how they have calculated the figure. So proposal 1, non-current liabilities are increased by 20 from the additional debt, and capital is reduced by the same amount. That means your share capital and your return earnings. Given that the share price is 3.2, the 20 million will buy back 20 divided by 3.6. I have exactly explained all this. They're just a repetition. This shares have a nominal value. So this is the nominal value, which is 2.5. The split between share capital and return earnings will therefore be 2.5 share capital, balance 17.5 return earnings. Actually share premium, but for simplicity it is return earnings. Additional interest payable 1.28 million. How 1.28 million? 320 plus this 2. 960 plus 320. Right, is taken off return earnings. It is deducted from the return earnings due to the reduction in profit after tax, and also deducted from cash as it is assumed to be paid in cash. It will be acceptable to include as a current liability if it was assumed to be unpaid. So one thing I want to say is, here we are deducting it from cash, current assets, but the other one is you can even take it as current liability, right? How? If you assume that it is unpaid, your interest is not being paid, but in that case, if you're doing it, if you're dealing with current liability, assuming that it is unpaid, then you have to state it clearly. You have to write that assumption in wordings, right? I assume, or it is assumed that cash, this is not, it's unpaid, therefore current liability will increase, reduce, whatever it is. You have to state. But most of the time, it is my advice which I want to give is, it's better to go for cash. It is easier to work in cash, right? It is easier to assume default position, assuming that it is paid in cash, because that's what we normally do in all the other questions. So once you learn also that it's in cash, it's easier also, because we have been working through all the scenarios like that where we assume that cash is being reduced, because we assume that it is paid from cash, so it's easier for you. But if you want to work in current liability, assuming it's unpaid, that is acceptable. Proposal 2, non-current liabilities and non-current assets both are increased by 20 million, so additional interest has to be paid, and also the new investment will generate an additional return of 15%, which is 3 million in income. The net income is 1.72, right? You take both the interest and deduct it from 3 million, so the net income is 1.72, which is this 1.72 is added to return earnings and also current asset, as it represent either cash or receivable, right? It could be a debtor also, it could be cash also. In any way, it will be added to your current asset only, because both cash and debtor receivable comes in your current asset only. Proposal 3, non-current asset are reduced by net value of disposal 25 million. Yes, non-current asset will be reduced by 25 million, but the proceed is 27, and this 27 are used to reduce non-current liabilities. Profit is 2 million, which is added to retained earnings. The reduction of investment in non-current means there's a lower return on investment of 15% of 25 million. However, interest will be saved on non-current liabilities, will be paid off. Of course, you're paying saving interest on non-current liabilities because you're paying off. So now what is the impact? Net impact is a loss of 2.318 million, which is subtracted from retained earnings and deducted from current assets as a cash expense. Again, it would be acceptable to include as a current liability if it was assumed to be unpaid. Same. Now let's go to discussion. This is very important. All this are not there needed for your answer, okay? All this explanation is for your purpose, for you to understand how you got the figure and what is the impact. I have explained it basically, but you can just go through and read it. Discussion. Now we need to discuss. Okay. When I'm discussing, keep the figures in front of you, the calculated figures, the answers in front of you, because I'm not going to go up, down, and show you the figures each time. Okay. So make sure that when I say figures are reducing, increasing, what it means. Okay. Proposal 1 will lead to small increase in EPS. Yes, if you see proposal from the current proposal 1, there's a small increase in EPS. EPS increased by small amount. Why this small amount? It increased. Whenever you are seeing something is increasing or decreasing or there is no change, you need to give a reason. Right? Remember that. So they are saying due to reduction in number of shares since earnings fall by about 5% because of the higher interest payments from additional debt. However, gearing significantly increased by approximately 6%. Yes, if you see gearing increased very, it is the highest gearing if you see under proposal 1. Right? From 45 it went into 51.9 something. So around 6%. But did you understood this reason why reduction in number will increase EPS? Because EPS, whenever you don't understand something increase or decrease, simple, okay, breakdown. Break down it into the formula, the numerator and the denominator. Always break it into numerator part and the denominator part. The formula basically. Write down the formula. Then you'll be able to understand why that change is there. Earnings per share. So in your numerator comes your earnings, which is E. Denominator comes your share, number of shares. Okay, I will write S. E divided by S, earnings divided by share. So your share is reducing, share is going down. Whenever your numerator goes down, you can try this. Numerator goes down, your number will increase. Right? Let's say my earnings is 1, my share is 4. Okay. What is the percentage? 25%. Now, earnings, keep your earnings same, decrease your share from 4 to 2. I'm reducing it. This is increasing. Can you see? From 25 to 50% is increasing. So if you reduce a number, this is a principle only. If you're very good in maths, you'll be able to know this. When your denominator reduces, whenever your denominator reduces, your numerator will be same. Okay. Only your denominator is changing. One variable only will change. Your number will increase. That's why when your number of share is fall, number of share comes in your denominator. So when your number of share is falling, what happens? EPS will increase. EPS will increase. But that increase is not so much. Why? Because at the same time, even your earnings is falling down. Even at the same time, your earning is falling down. That's why that increase is small. Why earnings is falling down? I'm taking a longer time for you to explain this because it's very important for you to understand this crucial part. It's very important. Once you understand this one, you can crack any question based on how to show the impact of change. Earnings is falling because you are paying interest now. Higher debt, higher interest. Simple. Right? So it's very important that you understand how totally proposal 1, how it is impacting. Okay, now let's go to proposal 3. Under proposal 3, EPS will fall. If you see from your current and proposal 3, your EPS is falling down. Now we'll see how. Although the total earnings will be higher than under proposal 1. See your total earnings. If you see under proposal 1 and 3, right, it is higher. If your earnings is higher, your EPS has to be higher, right? Because earnings comes in your numerator. So, but even though earnings is higher than proposal 1, right, in proposal 3, still EPS is falling. We'll see why it is falling. Total earnings fall because the interest saved and the profit on disposal are less than the loss of the return on the non-current asset investment. What does it mean? See, correct. Okay, it is correct that you are saving interest. There is also a profit on disposal. But still, if you add your profit on disposal and your interest saved together, still that saving and that profit is not so much compared to your loss. Your loss is greater. Which loss? Loss on return of the non-current asset investment. That it is less than the loss of the return on the non-current asset investment. Less. Your non-current assets loss is greater than that profit and interest saved. That's why that earning is falling. And what happens? Gearing would also reduce significantly by 5%. If you see, your gearing also fell down very by 5% from your current, right? Why gearing will fall? See, always ask a question. Stop, read a sentence. Okay, you have read. When you're studying, this is studying time. I'm telling you, this is how you learn by yourself only. You don't need any textbook or something. Ask this question: why gearing is falling? Why this is increasing? How it is reducing? Why it is impacting? It is better this way. You will learn. But if you try to memorize, you will not learn anything. Okay, so gearing will fall. Why? Under 3. See, in proposal 3, what you are doing? Non-current liabilities, right? Your non-current liabilities is reducing, right? So your non-current liabilities reduce means your gearing also will reduce because it is becoming less riskier now, right? It makes sense. Next, proposal 2. Proposal 2. See, you might be wondering why they first they discussed about proposal 1, they then jumped to proposal 3, then they talked about proposal 2. There is no fixed way. You can answer in any way. You can start with proposal 3 also, starting discussing. You can even start with proposal, any order you can discuss. There is no fix that you have to start with proposal 1, then 2, then 3. You can start in any mixed order, provided that you give the correct discussion, correct reasons why something is happening. Proposal 2 significantly increases EPS. If you see EPS, it is the greatest under proposal 2. So if you now see why they have given that proposal 2 at the end, maybe they wanted to show that EPS is the greatest, right? Even your gearing also, it's not, that increase is not so much. Like maybe it's in a better position compared to proposal 1 and 3. Maybe that's why they want to give the best one at the end. So that could be a reason why this answer is presented like this. If you want, you also can do that. The under those proposal you can give first where they are not providing so good results, and the best one you can keep till the end, or maybe the best one you can provide first and the other two you can wait in any order, right? It's just the way you write, it depends on your thinking process, basically how you think, how you want to present. So proposal 2 significantly increases EPS, which the other proposals do not. You need to compare among themselves also, with proposal 1 and 3 how proposal 2 is reacting, with current how proposal 2 is reacting. You have to compare like that. This is due to the, okay, one line you are saying it increased, second line you are giving the reason. This is the method of answering any AFM question. So this is due to the return on the additional non-current asset investment. In proposal 2, you are having an additional investment in non-current investment. That's why that EPS is increasing. Why? How that link? EPS is increasing because non-current asset of why? Again, I will tell you. I have told you this before. If you remember, break EPS into the numerator and denominator, earnings and share. So if you are making an additional non-current asset investment, your earnings will increase. Go and check your earnings increased. If your earnings increase, what happens? Earning is in the numerator. Automatically your number will increase. If you want this, let me prove this to you. This time, share will be same, will change the earnings, upper part. 5 divided by 10. Earnings is 5, number of shares 10. This will be 50%. This time we are increasing the earnings. It will be 10, share is also 10. It is 100%. So you see the number is increasing from 50 to 100. If you increase this to this is increasing. The whole logic is this, that if you increase your earnings, your EPS will increase. And your earnings will increase because you're having a return on that investment. You're having a return, you're receiving a return on that non additional investment. Because of that, your earnings will increase. That's why your EPS also will increase. However, gearing will also increase by just over 3%, although this is less than under proposal 1. Right? Even though your gearing is less than proposal 1, it will increase. Right? Yeah, of course, your gearing will increase because your debt increased, right? 20 million. Now, we'll see. Now you need to give your final conclusion in this last paragraph. This last paragraph, you are giving your conclusion already, basically. Right? So, proposal 1 is the least effective. Why least effective? Because proposal 1 is having the highest gearing and the lowest EPS. If you see, lowest EPS and highest gearing. So it's not good. If not lowest, we'll see. We'll go to the figures and see. 21.73. That increases not so much. Okay, but your gearing is very high, more than 50% also. So we'll see. So it is less effective. But now what happens is the choice is between proposal 2 and 3. Okay, see the way they are answering. Just go by the wordings they are using, the language they are using. Don't see whether it's 2 or 3, just see the words they are using. Because in this question, it is not clear cut whether proposal 2 or 3. You cannot say. 2 has some advantage, 3 has some advantage. So the choice, this is how you have to write your wordings. Choice between these two proposal will depend on blah 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 blah. So the choice between proposal 2 and 3 will depend on whether the board of the Ennea will prefer a higher EPS figure or a lower level of financial gearing. This may depend on industry averages for both of these figures, right? We need industry averages. How the stock market would react to the proposals and the implications of the proposal on changes to the risk profile of the company and whether this will change the overall cost of capital. It should also be noted that above the forecast and the estimate and the actual results may well differ from those stated. Whenever you are working with a forecast and you have to work conclusion, this last line, don't forget about this. If you go through your answers in AFM, you will see that this has been repeated, I think, maybe 1,000 times. Focus needs to be, it might differ, estimates might differ. This has to be there because you're dealing with forecast. It is a forecast, it is not a real, so it might change. Actual results might differ from this. So try to adopt this kind of the way of writing a conclusion. Try to write this way. Now we are done with part A. Good thing is that finally, okay, and finally we are coming to part B, which is securitization, and it is for 5 marks, right? Usually securitization, this part is not performed well by the candidate. The reason is, there are 2 reasons for this. First reason, candidates ignore this portion of the syllabus, asset securitization. They just ignore, they feel it's not important. Okay. Number 2, second reason, they do go through this, they try to understand the concept also, but they feel it's very complex and all the word itself looks very complicated. Securitization. Some of you, they misinterpret this, the whole meaning. They think it in some other way. It means they feel that it's asset collateral or something. Maybe you're giving something as a security to get a bond or a loan. That's what they think as a securitization, which is not at all. So the meaning itself only they will change. Okay, please don't take me wrong. I'm not saying in a bad way, but the truth is this. Lack of knowledge in this part, lack of preparation, lack of understanding. Even if you try to understand also, it looks very complicated, that you don't pay so much of attention also. You just go through, read, and that's it. That's why this part is, I'm I brought this here. I could have told you just go and read it, but I want to solve this here. I want to go through, read it, because it's very important that you really work on this part. Securitization. Because you should not be in such position in exam that you have worked 100%, you have covered all the syllabus everywhere, but you have not worked in securitization and you're losing marks and you're failing. I don't want that to happen, right? So let's work through this. Sorry for those long, but it needs to be given, right? Otherwise, okay. So yeah, what is asset securitization process, and what are the barriers? Asset securitization for Ennea would involve converting the future lease income from the non-current asset leases into assets and selling these assets as bond notes. Right? This is easy to understand. So the future income is then used to pay the coupon on the bond. In effect, the company forgoes the interest payment on the leases in favor of the bond sale proceeds. When you talk about securitization, talk about these two things. Tranches, tranches and credit rated. These two things needs to be talked. That's why they are in bold. This needs to be included in your answer. That's why it's bold. So the lease income would be aggregated and pooled, and new bonds would be created based on this. Based on the lease income, they are creating bonds. So the pool assets are divided into tranches. If you see, there are a number of tranches: tranche A, tranche B, tranche C, and the tranches are credit rated, right? A rated, B rated, C rated, or double A rated, triple A rated. The higher the rated tranches would carry less risk and also have a lower return. Yes, because lower the risk, lower the return also. Then tranches with a lower rating. If default occurs, the income of the lower tranches gets reduced first, and any subsequent default is applied to the lowest tranche with any income left. This process means an asset with a low level of liquidity can be transferred into a security with a high liquidity. This whole process you need to understand and write it in your own words. You should be able to write in your own words how the tranches are divided, how they are credit rated, what it means, even in the event of a default, what could happen, right? All this thing you need to explain. Next, now we are going to talk about the barriers, third and the fourth paragraph. So there are a number of barriers to undertaking a securitization process. That means what they are saying is it's not easy for the company to go into this process. There are some problems, issues. What are those? It is very expensive due to management costs, legal fees, ongoing administration, compliance cost. So companies looking at selling a relatively small amount of non-current assets, and therefore the cost would be significant proportion of the potential income. This high cost means that the securitization is not feasible for a small asset pool. What is Ennea currently doing? They're only selling a small proportion of non-current asset. It's not that they're selling a huge amount of non-current asset. For securitization to take place, for that process to work effectively, you need a huge amount of non-current assets, pool of assets. It will not work with small asset pool. That's why they are saying it's not feasible. It's very expensive. Cost is more than the benefit. Right? It is usual to not offer the full value of asset in the form of securities, but to leave say 10% of the asset value as a buffer against default and converting the other 90% into securities. So what happens is the full value of asset you are not converting into securities. Only out of 90% of that value you are converting into securities. You are leaving the 10% aside as a buffer, because in case a default might happen, you can use that 10%. Okay. So the method of credit enhancement would give the tranches a higher credit rating and therefore improve their marketability. Right? Make sure that you know what is credit enhancement. Make sure you know what is credit rating. I have made a video also on this. If you want, you can go and check my videos on credit enhancement and credit rating. When I was explaining my syllabus, you will get it in my playlist, Advanced Investment Appraisal Lecture. In that playlist, I have credit enhancement and credit rating. Go through that. And therefore improve their marketability. Right? The higher the credit rating, better it is. However, if the company wants to use this method, it would not be able to take advantage of the full value of the asset. Right? So that's it for securitization and also our impact of reconstruction on the financial statements. Now let's go to our marking scheme. We'll see. Okay, part B. First we'll go through part B. It's easy, 5 marks. So explanation is 2 to 3. Barriers is 2 to 3. Part A is 20 marks. How that 20 marks is divided, we'll see. 3 marks proposal 1. Okay. 2 proposal 2. 3 proposal 3. Now, adjustments to focused earnings. So these are the things. Interest payable on additional borrowing and higher coupon. So for additional borrowing, 1 mark. Higher coupon, another 1 mark. That's how you're getting the 2 marks. Interest saved on lower borrowing and lower coupon. 1 mark. Because only there is one. Only in investment or proposal 3, you are getting a lower borrowing and lower coupon. But additional borrowing and higher coupon, both in proposal 1 and 2. That's why it's 2 marks. Return on additional investment. There is only one return on additional investment. That's why it's 1 mark. Return lost on less investment and profit on sale of non-current asset. Again, is 1 mark because this comes in proposal 3 only. Gearing and EPS calculations. 2 marks. Discussion of the result of the proposal. 2 to 3 marks. Right. So that's it for this. Keep watching my videos and see you in my next video. Till then, take care. Bye bye.